East Africa now, despite a fall in headline inflation in August to 5.84% from well over 6% the month before, Kenya is not out of the woods just yet. Analysts at StratLink Africa argue that between adverse weather, especially El Nino, a currency against which the dollar is up by over 16% in the year to date, inflation is still poised to rise. Earlier today, I spoke to one of the company's analysts, Julian Tomboko, to get a better feel for exactly where investors are putting their money, if not in the country's equities.
It doesn't necessarily change on food inflation because the factors driving it are particularly, if I may say, not very clear at the moment. We have the weatherman forecasting El Nino anytime soon, so we haven't really considered how deep that could run. But from a money supply perspective, if you've seen the trend, the KBRR was hiked in the last monetary policy sitting, and we believe that could be one of the factors that are driving the inflation going downwards.
Indeed. Speaking of El Nino, however, how worried should we really be about this particular weather phenomenon?
I think really it's about the weatherman to tell us, because from an economic standpoint, we know that it could have an impact in terms of food supplies. But until we have very concrete data guiding us on the intensity of the rainfall, we can't really put a finger to it. Indeed.
So a lack of data there clearly being a problem. Let's talk about KBR in particular, because we noticed when it came into force, lending rates essentially declined, and we saw the volume of lending also go up quite a bit. What are the odds that the central bank might decide to tweak KBR a little further in its next meeting?
I think if you look at the monetary environment right now, especially from an inflation perspective, there is little, if any, incentive to tighten any further. I think the CBK might be more concerned about gauging the measure of transmission effect it's having on the entire economy. So as to the chances that it will be hiked, not that we can tell, but you do realize again with the shilling now oscillating around 105, 106, the central bank might again be keen to make a very bold statement that we are in charge of the monetary environment.
But what sort of bold statement would that be? I mean, they can't raise rates much further without essentially nuking what little growth we have.
Certainly, it is in a tricky position in terms of the direction of the rates. But as we have said before, we have had now the CBR going up by 300 basis points. So it really now remains to be seen how the economy as a whole responds to this kind of transmission. We are still waiting for Q3 data to be able to see how much this has impacted on growth.
Let's talk about equities and bonds. There's some interesting stories happening over here. The NSE 20 has been in decline. It's hovering around 4,100, just above that level. Yields, however, on the short-term end, 182-day T-bills, 364, 91-day, also heading up. Are we seeing fund managers reallocating cash towards short-term paper and getting out of equities altogether?
Absolutely, because right now, as we speak, with the shilling on a tailspin, as it were, really, most people are keen on a safe bet, especially for the near term. So we could easily be seeing a lot of investors exiting the equities for the fixed income market. And until, from a StratLink perspective, until we see the shilling gain a bit of resilience against the greenback, we are likely to see the equities remaining on the downtrend.
But that isn't going to happen anytime soon, given the factors we've just discussed, isn't it?
It's highly unlikely that it will happen anytime soon. We are still waiting for the FOMC meeting on the September of the 17th, so we'll see how it goes.
Indeed. Speaking of equities, however, capital gains tax, this story seems to have moved off the headlines quite a bit, partly because members of parliament are debating the finance bill. But as far as we know, the removal of CGT on equities is not retroactive to the 1st of January. Isn't that also just going to keep investors off the NSE 20 for quite a long time to come?
I think if there's anything about the CGT, it's largely because there's a lot of uncertainty and grey area as to where exactly it's going to lie at the end of the day. So most investors would rather take a wait-and-see stance before taking a deep dive into the market. But we're still waiting for Parliament to wrap up its debate and give us a way forward on the same.